Here's the thing about investing in 2026 with just $100. Waiting until you have more money is the single most expensive mistake you can make. And the reason comes down to one concept that changes everything: compound interest. Let me show you the math that changed how I think about this. Invest $100 today, add $100 every month for 30 years at a 7% average annual return, and you end up with roughly $121,000. That's compound interest working in your favor. Your money earning returns on top of returns year after year. Wait just 5 years to start, doing the exact same thing, and you end up with $82,000. That's a $39,000 penalty for waiting, and not because you invested less money, because you invested less time. The numbers get even more striking when you zoom out. Start investing $100 a month at age 25, and by 55 you'll have approximately $226,000. Start at 35 with the same contribution and the same markets, and you'll have about $76,000, less than a third. Time isn't just a variable in investing. It is the variable. So here's exactly how to do this, step by step, starting today. The old barriers to investing are gone. Every major brokerage in 2026 charges $0 in commissions on stock and ETF trades, and every major platform offers fractional shares, which means you can buy a piece of Amazon, Apple, or an S&P 500 index fund for as little as $1. Costco trades at nearly $900 a share right now, but you only need $5 to own a sliver of it. The barrier to entry has never been lower. The only real barrier left is the one between your ears. Before you invest a single dollar, you need to pick the right account type, and this decision matters more than which stock you buy first. If your employer offers a 401k with a match, that's your first priority. Full stop. When your company matches 50% of your contributions up to 6% of your salary, that match is an immediate 50 to 100% return on your money before the market does anything. That's the highest guaranteed return available to any investor on the planet. Contribute 6% of a $20,000 salary, which comes to about $100 a month, and your employer turns it into $150. Free money. Take it. After you've captured that match, or if you don't have an employer plan at all, your next move is a Roth IRA. For 2026, the contribution limit increased to $7,500 if you're under 50, and $8,600 if you're 50 or older. Those limits are current as of June 2026. Single filers earning under $153,000 or joint filers under $242,000 can contribute the full amount. Your money grows tax-free inside a Roth IRA, and you pay zero taxes when you withdraw it in retirement. For a beginning investor, it's the single best account type available. And one thing worth understanding here is the difference between a Roth IRA or traditional 401k, which are retirement accounts with tax advantages, and a standard taxable brokerage account, which you can open with no income limits and withdraw from at any time. Both have a role in a complete financial plan. The retirement accounts give you the tax shelter. The brokerage account gives you flexibility. Now you need a platform. And in 2026, there are genuinely excellent options depending on what kind of investor you want to be. If you just want to start and not think about it, use Acorns. It links to your debit card and rounds up every purchase to the nearest dollar. Buy a $3.75 coffee, and Acorns rounds it to $4, automatically investing that 25 cents. Those roundups compound quietly in the background, and you build the investing habit without the mental load. If you want to actually learn how investing works, go with Fidelity or Charles Schwab. Fidelity earned the title of Best Investing App for Beginners in 2026 from NerdWallet, while Schwab ranked #1 overall in the 2026 Annual Brokerage Awards. Both have deep education centers, real tools, and you'll never need to switch platforms as you grow. Fidelity lets you buy fractional shares of more than 7,000 US stocks and ETFs starting at just $1. If you'd rather have a smart app manage everything for you, Betterment is your answer. It's a robo-advisor that builds, manages, and rebalances your entire portfolio based on your asset allocation, your personal mix of stocks and bonds based on your age, goals, and risk tolerance for a quarter of 1% annually. On $10,000, that's $25 a year. Compare that to a traditional financial advisor charging 1 to 1.5%, which over 30 years can consume roughly 27% of your entire portfolio. The robo-advisor landscape in 2026 is seriously competitive. Vanguard Digital Advisor charges as low as 15 basis points with just a $100 minimum. Fidelity. Go charges nothing on accounts under $25,000. The industry now manages over $1.8 trillion globally, and these aren't toys. They're legitimate wealth-building tools. So what do you actually buy with your first $100? For the vast majority of beginners, the answer is a broadly diversified index fund, or ETF. One purchase gives you instant exposure to hundreds or even thousands of companies, and you don't need to pick winners. You own the whole market. This idea that ordinary investors are better served owning the entire market than trying to beat it was pioneered by Jack Bogle, who founded Vanguard in 1975 and launched the world's first index fund available to everyday investors. His insight was simple. Lower costs and broader diversification beat active stock picking over time. The data has proven him right. Here are the names to know. The Vanguard S&P 500 ETF, ticker VOO, became the world's first trillion-dollar ETF on June 3, 2026. Its expense ratio is 0.03%, which works out to $3 a year on $10,000 invested, compared to the industry average of 23. Other excellent options include the Fidelity 500 Index Fund, ticker FXAIX, the iShares Core S and P500 ETF, ticker IVV, and for total market exposure, the Vanguard Total Stock Market, ETF, ticker VITI. One more thing worth knowing about these funds. When the companies inside VOO or VTI pay dividends, those payments get automatically reinvested to buy you more shares. This is called dividend reinvestment, or DRIP, dividend reinvestment plan, and it's one of the quiet engines powering your long-term compound interest. You don't have to do anything. The fund does it for you. The average index fund expense ratio in 2026 sits at just 0.06%. The average actively managed fund charges 10 times more. And here's the kicker. Research published in the Journal of Finance found that the average individual investor underperforms the market by 1.5% per year, while active traders underperform by 6.5% annually. Statistically, you're better off buying the index and going to lunch. Now let's address the obvious concern. The S&P 500 is up 10% in 2026 as of early June, trading at record highs with a CAPE ratio sitting at 42.5, a level not seen since the dot-com era. Shouldn't you wait for a pullback? No, and the data is overwhelming on this. The S&P 500 has climbed 92% since the bear market low in October 2022. Wall Street analysts expect earnings to grow nearly 20% this year, the fastest pace since 2021, driven partly by massive AI infrastructure spending. 85% of S&P 500 companies are beating earnings estimates, well above the 5-year average of 78%. The market spends far more time going up than going down. But here's the real reason not to wait. A 2025 behavioral finance study found that investors who check their portfolio daily are 5 times more likely to sell during a downturn than those who check quarterly. Dalbar's research showed the average equity investor earned 5.5% less than the S&P 500 in 2023. And that gap is almost entirely explained by emotional decision making. People buying high on excitement and selling low on fear. So here are the mistakes to avoid. Don't invest before you have a basic emergency fund, and by basic, I mean at least 3 to 6 months of living expenses sitting in a high-yield savings account somewhere safe and accessible. That cushion is what keeps you from being forced to sell your investments at the worst possible time. Don't put everything into one stock. Don't chase social media hype. Don't check your portfolio every day, and don't wait for the perfect moment to start, because that moment was yesterday, and the next best moment is right now. The generation that understands this best might surprise you. Gen Z made their first investment at an average age of 20. Millennials started at 26, Gen X at 28, and Boomers at 31. Each generation is starting earlier, and 44% of Gen Z investors plan to increase how much they invest this year. Your action plan is this. Today, open a Roth IRA or a brokerage account on Fidelity, Schwab, or Betterment. It takes 10 minutes. Deposit $100, buy shares of VOO or VTI, set up automatic monthly contributions, even if it's just $50, then close the app and don't look at it for 3 months. That's the entire strategy. Compound interest, time, and low-cost index funds. The three forces Jack Bogle spent his career trying to get ordinary people to use. And 30 years from now, you'll understand exactly why starting mattered far more than starting big.